Ron, thank you very much for joining us today. And you are a 25-year veteran of the real estate and mortgage markets in Canada.
I am
You
old. Yes, I'm old.
and, no one had said that, Ron. We said is you're seasoned, is what you are.
Yeah,
And
seasons makes me sound like a steak. Okay, but that's all right.
You've got, I follow you on Twitter, and you've had some very insightful things to say, and you get in discussions, I know, with other real estate people there, and it makes for some interesting reading, and that's what brought my attention to you. But as someone who's been around as long as you have, and with a business as successful as you have, you're a mortgage broker, an independent mortgage broker. I think you operate in Ontario and Alberta and British Columbia.
Correct. Yeah.
Maybe it would be good for you to say precisely what it is that you do in your own words and how you do it.
Yeah, mortgage brokerage is a simple concept, is that there are many lenders, multiple banks, and all types of other lenders, mortgage lenders who use mortgage brokers. And the concept is simple, that if we can take one application, look at multiple lenders, we should be able to find consumers a better deal than just one consumer going directly to their own bank and only getting one rate quote. That's the thumbnail sketch of how it works.
If someone's walking in and they said, help me find a mortgage, and you say, well, we'll compare it across banks. How many banks are you realistically comparing numbers to? Is it mostly just Charter One banks? Or are we going beyond them?
No, well, we will go well beyond them. There's a number of huge mortgage operations in this country. Comes to mind, MCAP, First National. There's many, often offering lower rates for exactly the same mortgage as the banks. But we also have access to two of the biggest banks in Canada as well. So actually, more like three. But in reality, it's more than just going to one. It's a lot more. So you're always better off to shop. Mortgages are a commodity. It's completely different from investment. It's an investment. I think 95% of everyone, maybe 99, needs advice. They just need advice if they have genuine wealth or even modest wealth. They need advice. And because the universe is a jillion possibilities. Maybe that's an exaggeration, but it's a lot. That's not true in mortgages. Mortgages is the customer selects the product they want, and it's up to us to find them the very best deal within the framework of their application. That is not a hard process. Not really. I mean, it takes a lot of honesty, because you're often, working to find the best deal that doesn't pay the mortgage broker as well. But that's all it takes: honesty, knowledge. But it's not this vast universe of investment possibilities. It's just not like that. So,
well, I think we're going to have a great talk today, but I want to say that I'm going to try and stay focused on both what you do. I also hope that we can get into some of the hypothetical things around what we think is going to happen in the market. But to get started, and I'm sorry if I cut you off, you want to get back to what you were saying. I just want to say in the past few years, Canadian real estate. Yeah, go ahead.
Sorry, I made the cardinal mistake of not going on do not disturb. Sorry about that.
In the past few years, Canadian real estate's obviously been a very hot topic. I think in 2021 and 2020 as well, real estate got to be in about 10% of GDP in terms of buying and selling activity. Better Living had a headline saying in Q1 of this year, it was housing was 50% of GDP growth. So and suddenly we find ourselves in a new world, which is maybe not new so much as one that we're revisiting after a long hiatus, but it is one that has rising interest rates, a hawkish central bank, a lot of uncertainty, people with different types of mortgages out there. So I guess the place I had hoped to begin is you're someone knowledgeable. You've got a lot of experience, real hands-on experience in this business. You're trying to explain to someone what the real estate market is that they find in and what your role is inside of it. What advice are you trying to tell someone today about getting involved in Canadian housing?
Well, obviously, people fall into different categories. If we were to talk about people who are looking to become first-time buyers, that's a that's the piece of advice that is probably just wait, unless you're absolutely have to buy. Just wait. Uh, there's no doubt that prices in almost every city in Canada will grind down lower. So if you don't have to make a purchase, like in other words, if you knew that you had to buy a car, but you knew that the car you wanted would be cheaper for exactly the same brand new car in 4 months, you didn't have to buy that day. I think everybody would wait. And that's the advice we're giving people today.
Okay. I sense that there is a lot of, I don't want to call it panic, but there's certainly impatience for Canadians because many people feel that they've been shut out of the housing market. I think we've watched over the pandemic probably a multi-generational wealth transfer go on to help get people, first-time home buyers, into the market, in addition to a lot of other, including investors, both professional, institutional investors, as well as individual investors. I think now that we've got rates rising, but rates aren't that high. You know, we're still below where rates were in 2008. We're below where rates were, through the early 2000s. Rates got very low. I think they got to zero effectively. How high are rates now, and what is the real, like, why is this 4%? Why is 4% such a problem for people when we were looking at 6% in 2005? 6-7% 2005.
Yeah, I was around in 2005. We did very little mortgage. Sometimes you're looking at posted rates, and we did very few mortgages and 5s and 6s, if any. It was definitely higher. It was absolutely higher than today. But I can give you a really succinct answer. Every house didn't cost $1 million in 2005. And that's the key. I mean, the key is the incredible run up in house prices means that a change from 2.59 to 4.89 or 519 is unmanageable. It's just unmanageable when the price of houses is this high. So that's the difference. You know, in 2005, very nice 2-story home, 3,000 square feet in outer suburbs, whether it's North York or Peel, 200 and about 389,000. $1.2 million today, and that's down from $1.6 million. So, yeah. You know, we just have a completely different world of pricing. And real estate is really just mortgage math, because the vast majority of people who are buying need a mortgage. And if that's true, the mortgage has to be affordable to allow the purchase to take place at a specific price. If the interest rates have doubled in 9 months, that changes the whole landscape of what you could afford to pay and what you can buy. So there's where the differences lie.
So I think a lot of people get primed from 2008 and watching the American housing market implode.
Mm-hmm.
The same, there is a sense right now of people are saying, well, the same thing's going to happen here. But Canadians have a different relationship to their debt, particularly mortgage debt. You can't just walk away from it. We've also been stress testing. How much of that do you feel will protect, I guess, both the homeowners, I guess, or protect the housing market generally, and the creditors, the banks who have lent out that money?
It's a good question. Most important thing to understand is that the mortgage crisis, which led to the world financial crisis in the United States, bears no resemblance to anything we've ever done in Canada. I'm a student of that debacle, not just a student who watched the movie The Big Short, but I've read 100 books on the subject.
Yeah.
And the reality is, it's a simple concept. Because U.S. mortgage lending is different than ours, because the people who sold the mortgages could hand off the debt to a completely different entity very easily, in some cases with completely unrealistic disclosure to that other entity, or the other entity chose not to understand the disclosure. In the end, in 2006, 2007, the most ridiculous kinds of financial offerings were taking place ever in the credit universe. People were getting 100% mortgages, like 100% mortgages on a house, with income that they wrote on a piece of paper and signed themselves. And their beacon scores, their FICO scores, were so low, they couldn't get a credit card in any other country. So we have a 525 FICO score, signing a blank piece of paper describing their own income, and 100% financing of that house. So you're going to have some problems if you do that. That's exactly what happened in 2006 and 2007. So it's a completely different world. We have never in Canada done anything but quality underwriting of a mortgage. Yeah. I mean, everything we do about completing a mortgage application and underwriting that mortgage makes sense within the whole world community of how lending should be done. So it's just a different situation. There's reason for people to be worried because prices are falling, but there's no comparison between what happened in the US and what's going on here right now.
So we can rest easy that we're not going to see the entire implosion of our banking sector and everything else that goes along with it. But as you say, prices are falling. So if you're sitting today and you're wondering to yourself, my house could be, my equity can just be gobbled up by falling prices. In fact, that equity, we could go into a negative equity situation.
Yeah, you could.
Our mortgage can be underwater.
Yes.
When does that become an actual problem for us? Because it's one of the things I'd noticed is in 2005, the Atlantic actually ran an article about the number of mortgages that were underwater in the United States. So it wasn't like they didn't know that there was a problem brewing. Their interest in the problem was minimal.
Yes. Good.
In Canada, people have been, we're hardwired perhaps a bit differently because we've come through that crisis, but saw no impact in real terms to the housing market. It was very minor overall. And the housing market basically resumed an upward trajectory. Now we're at some, as you point out, a house that would have been $300,000 not that long ago, up to 1.6, now selling at 1.2. What is I'm trying to see if I can get to the nugget of this question here. When is it a problem for both the borrower and the bank that house is no longer got any real equity in?
It's only a problem when the borrower stops paying.
Okay.
We in Canada, we do full covenant, full recourse lending on mortgages. In other words, we look at under every single rock, we check every aspect of income, we detail where every penny of down payment comes from. We are hard on credit scores. We do all those things. So the human being was stress tested when they got that mortgage. They were tested at a higher rate than they actually got, so that we've analyzed their entire financial picture based on a higher assumed rate. So we know they can make the payments. Don't get me wrong, unemployment is far more important than values falling. Values falling is important, but unemployment, when it comes to a mortgage, is more important. If people can work, they pay. We have full recourse mortgages in Ontario particularly, and most of the other provinces of Canada. You can sell your house at a loss where the bank can take it away from you and sell it at a loss, but they'll come after you and garnish your wages and capture all the money back. So it's not the same as the United States, and it is certainly something people understand. Therefore, if you can pay, even though the house might be worth $100,000 less than the mortgage, the entire Canadian experience is that people keep paying. I can point out the energy crisis in Alberta in 2015. There was massive job losses, and yet there was virtually no default on mortgages in Alberta at that time. So even in the throes of unemployment, even in the throes of the prices for those houses falling dramatically, in Alberta, Calgary, house prices fell 30%. No default, because people found a way. They got gig work. Well, one of the spouses, the spouse that wasn't laid off, worked a few extra hours. They kept paying their mortgage. And it's proof that in Canada, we are serious about making payments. But your point is well taken. When people's behavior does change slightly when their house is worth less than their mortgages. They still make the payments, but they're not going to renovate anything. They're not going to, they might, if the payments go up, because let's face it, if you have a variable rate mortgage, there is a 20% chance the payments will go up. They will find having to do less of other things or spend less in order to make that mortgage payment. So there will be pressure, but it's not the kind of pressure that is automatic. As long as people are working, they make the payments.
Okay. I think that's kind of fair. And one of the things that you highlight, and it reminds me that Canadians are, a lot of our debt is tied up in our houses. It's far more than things like credit cards as well. I think HELOCs and mortgages make up easily about 70% of Canadian,
if not more,
if not more.
Yeah.
But HELOCs HELOCs are very much for spending, right? I mean, it's not. You may renovate your house with it or whatever it is, but you're tapping into your home equity so that you can do something else. Mm-hmm. And for a long time in the Canadian market, at least in the Canadian economy, the only growth has really come through consumers. It's consumer spending. And when you see that, a lot of the spending has come through debts attached to houses, there's a concern here. There's been a concern in my sector of the business for a long time that Canada doesn't look like a good place to invest. Banks are doing great. When the price of oil is high enough, the oil sector is doing great. But when you're looking at the nuts and bolts aspects of the economy, you're looking at a population that is not as productive as its neighbors. It doesn't have the growing economy, and all of its economic growth comes from largely debt-based spending for consumer goods. It's not how you would like to structure an economy that you want to see grow. And the feeling about house prices coming down should lead to both a contraction in HELOCs makes us, as you say, there will be pressure, but that pressure should eat into a lot of where we think our GDP is coming from. And I don't know if you have a comment about that.
Yeah, the reality is that there is a English language disease amongst nations. The exception is the United States. I mean, there's sort of focus on individualism and individual accomplishment, and their great history of business success has kept them relatively productive. But if you look at Canada, Australia, New Zealand, and to a certain extent Britain, they've all suffered from the disease of the financialization of their lives. In other words, debt means more in those countries than opening up than a greater earnings from your job. You've hit upon something that's really, really important. Why would someone up to this point in Canada, a young person, a person in their 20s, why would they want to get a job or open a small business or pursue a career that's going to take years to reach a point of big income through success in the job? Why wouldn't they just become a real estate agent? Why wouldn't they just learn to flip houses instead of opening a small factory? Why wouldn't they become focused on rental properties instead of developing a new app, be the next Shopify? Why would you bother in your 20s? Because clearly it makes more sense to be a real estate agent. If a mildly successful real estate agent can make $200,000 a year, and let's face it, that's only about 6 or 7 transactions in Toronto and Vancouver, why would you do anything else? So fundamentally, to your question, that's a bad situation for a country to develop themselves in, to base their economy on, to base their societal direction on, is don't open a business, don't develop an app, don't do medical research, just flip houses or become a realtor. Terrible scenario, but also true in those other English-speaking countries that I just mentioned, except the US.
Michael Lewis had a great line in his book, a very short book, but it was Boomerang, immediately following 2008. And he had a line about the Irish who of course had a massive housing implosion, and said
Collapse.
that what we discovered about the Irish was that left in a dark room with a pile of money, their greatest desire was to sell houses to the Irish. Like it was a.
It's a good quote.
I want to eventually get into talking to you a bit about the effectiveness of the Bank of Canada hiking, and I want to explore some of that. That's some of the hypothetical. I think before we do that, I want to imagine three people. We've got a person who bought a house maybe 5 years ago, and they're coming up to refinance. Someone that bought a house maybe late last year in a variable rate mortgage and are wondering what's going to happen because they're seeing their rates go up. And then someone who is, as you said, maybe trying to get into the market for the first time. I think you've already given us an answer to that, which is wait. But for maybe those first two people, starting with the person that's, maybe had a rate around 2.3% in 2018, and they're now looking to have to refinance in the next 6 to 8 months. What would you tell them? What's the advice that you in your independent role can tell them about how to get the best rates?
The advice we typically give is to take a short-term fixed. Even though the rates on the short-term fixed are about the same as the 5-year fixed, take a short-term fixed, because we are looking at 14-year highs on 5-year fixed rates. So just the most sensible approach would say, let's see if they go down. They're not going to go back down to 2.59, 2.39, 2.69. Then it's not going to happen. But there's a definite chance that eventually it'll be 3.89 or 3.99, which beats the hell out of 509 or 519. So short term at, say, 4.69, 2 years, find out after 2 years, do some planning, pay the mortgage down. But definitely, it doesn't make a lot of sense to panic and think that the mortgage rates are in five years from now are going to be 7.8, because they're not. So the reality is, take short term if that is a useful plan. Take short term if it works for your situation, and in 2 years, 1 year, 2 years, reassess and determine what might be a better scenario for a longer term fixed at that time. Even variable might come down and stay down within 2 years. The other scenario is the person with a variable rate mortgage. Only about 22% of the variable rate mortgages go up. Well, payments go up when the rate goes up. That's still a big number, still tens of thousands of households. But majority have not seen an increase. Most of those bank mortgages for variable, they don't increase in payment. Within the mortgage itself, the mortgage is a combination of two things. It's interest and principal payment. What happens is the interest portion of the payment grows and the principal pay down shrinks. Now, at the point where that actually crosses over the horizon and your mortgage is actually going up, what you owe the bank is going up instead of coming down. At that point, that's called a trigger point, and some adjustments have to be made there. But we probably won't reach trigger points until if the next increase is 75 beeps, you're going to be, from the Bank of Canada, you're going to be hearing about more trigger points happening. But
right specifically, now, Ron, what is a trigger? You mentioned it the other day on Twitter, and I asked you about it. But what is a trigger point exactly, and who uses them, and when would they get used?
So a trigger point really is, although some mortgage experts like to argue, oh, no, it has to do with when your mortgage grows so much that it's no longer a conventional mortgage. But in reality, every bank in Canada, when your mortgage, you're no longer paying off a penny of it. When you've got a mortgage that was supposed to be a 25-year mortgage, and you've reached the point where actually what you owe the bank is growing, that's called a negative amortization. When that happens, every bank in Canada is going to contact you and suggest that you make some kind of a change, because no bank can get away with the idea that we're just going to surprise the hell out of these people when their mortgage renews and tell them you owe us more than when you started.
Yeah,
like there is no chartered bank does that. It doesn't exist. So you will be contacted. Suggestions will be made. You may not be forced to increase your payment, but you will definitely be told about the fact your payment should increase.
Okay. We have a couple of questions, and I think they're a good place to go before we pivot to some more general stuff about interest rates. On the topic of stress tests, we started a $1 million mortgage 2 years ago with a 1.26% interest rate. Still blows my mind. Our interest rate has tripled in the past year to 3.51. If it keeps going up, will we pass a stress test when it comes time to renew in 3 years?
One thing to understand about mortgages in Canada, because all mortgages in Canada, there's no such thing as a 25 or 30-year term in Canada. There's 1 year, 2 year, 3 year, 5 year, 10 year. Really, you'd be hard pressed to find a 15-year term. So every mortgage theoretically must renew. You're not going to pay the mortgage off before the term is up. So in those cases, there is no stress test applied to renewal. When your time is up and you need to get a new rate, a stress test will not be used. As long as you've made your payments in a perfect fashion and you're up to date on your mortgage, all that will happen is a new payment will be struck because obviously rates have gone up. You'll be offered a series of options, whether it be fixed or variable, from your existing lender, and you'll pick one of them. Or you may want to try to shop, and that's where the stress test comes in. If you want to shop, the stress test may interfere with your ability to go out and look for a better deal. However, you are guaranteed, as long as your payments are up to date, that you will be offered a renewal and it will not be stress tested. They won't even ask you anything about your employment. They won't ask you to reappraise your house. They won't ask you any of those things. You'll simply be offered a renewal.
Okay. If someone's going to risk the stress test and we're looking at rates that are, 4% now or north of 4%, how much better do you think it's going to be is it worthwhile to go shopping? I mean, you're in a good position to say, I think, comparatively what the benefits could be. If you're with Scotia, I mean, and your mortgage comes up, what would you recommend?
The basis of our business, the reason for our company's existence is to shop. Our contention is that in almost every case, we will be able to find you a superior rate to the initial renewal offer that your lender makes. Now, sometimes the lender will match us. We'll come up with a better deal, and the customer will go back to their bank and say, hey, Butler says he can get me this rate. And typically the person at the other end of the line says, oh, those goddamn Butler people again. And we'll match. Okay. But absolutely. It's just like anything else that's a commodity. This is not advice. No one's giving you advice where you need to depend on people's wisdom, experience, and honesty. We're honest as hell, but we also will find you the best rate. And it's a commodity. It's a commodity. It's no different than if you drove around and looked at 6 gas stations and tried to find a lower price of gas. If you find one, you'll pull in and you'll fill your tank. That's the service we provide. We will find the lowest possible rate that we can offer.
Okay. A follow-up question here then is, a condo in Regina must be under different pressures than a semi-detached in Toronto. What is the relevance of national housing data, and what is the most relevant indicator of performance in a future market?
All real estate is local. All real estate is local, not just to the city, to the neighborhood, to the street, sometimes even to the house on the street. So the data is just a huge agglomeration of information that spits out some averages. The truth is, it's about your personal situation. It's about where you live, right down to the street and the house. So in terms of will you be in a better or worse situation? Will your mortgage be underwater? Will it be easy to sell your house? Those things are incredibly specific. And the data that rolls out from national is not of much use to individual human beings. It's just of use to people like me who are in a business that looks at thousands of applications in a year.
Okay, that's good. I think that's probably fair. I've always tried to, rightly or wrongly, relate houses to cars, and that is that it's an expense. It just so happens that for the last little while, the value keeps going up, but it's an expense. And so long as you're living in it, that's the thing that probably matters the most to you. So
by and large, Canada's a cold country, and even in Vancouver and Victoria, it's pretty wet. So you need a roof over your head. And, that's a motivator to keep making the mortgage payments. And our government's very rational about this question of 5-year terms or 2-year terms or 3-year terms. They make it clear, our government and the regulator of banks and lenders and all the other regulators make it clear to mortgage companies that they must offer renewals to perfectly paying customers. So it's never really a critical issue.
Let's pivot away. I want to talk a bit about interest rates and inflation, because I think this is my view. I have a bugaboo about inflation. One of the things about inflation is that inflation's actually been, I believe, much higher over the past 10 years than CPI gives you. And as a quick refresher to anyone that will watch this at any point, the CPI is made up of a basket of goods. It's about 700 some odd things. The government of Statistics Canada changes it up, but at the core of it, it's a bunch of stuff that you use. And, you know, if some are going down or some are going up, you get a core price index, a consumer price index that we can follow along with. But some of that's skewed, right? I mean, that basket includes clothes and electronic goods and all these things that have been declining in price for a long time. And it includes a lot of stuff that you buy every week, like food, which has been going up in price for a long time. And if you are looking to relevant information about inflation, what the cost of living is inside Canada, I would, as I've got 2 young children, I pay attention to how much I'm paying at the grocery store. I pay attention to how much childcare expenses are. And both of those things have been rising pretty much unrestricted for a long time. In fact, I ran numbers some time ago. I share them if anyone wants them, but I grabbed them from Statistics Canada. It was a 10-year period of 2010 to 2020. Baby food, 128 milliliters, went from 80 cents a container to $1.53, which was a 91.25% increase in 10 years, or an annualized rate of 9%. That's a big, like, I mean, if I could produce a 9% annualized growth rate for my clients, they'd be very happy. But, you know, all you needed to do was own baby food, it turned out. So it's this kind of stuff, I think, it creates skewing. And then we come to a situation like the pandemic, which is no one in living memory has got an experience of dealing with something on this kind of scale. And this is probably the first time any government, let alone global governments, have said we're going to fight and beat a pandemic, as opposed to just, you know, crossing our fingers and hoping for the best. Took extraordinary measures, but along that route, we obviously reduced interest rates. That helped balloon the cost of housing in particular, as well as the stock market, and a host of other, I'm going to say, non-tangible false scarcity goods like cryptocurrencies and what are they called? NFTs, which have both fallen off a cliff this year. I feel like we live, I'm trying to get to our point here, Ron, but I feel like we live in a bit of a paradox when it comes to inflation. In meaningful ways, inflation for Canadians has been higher in consumer goods, in particularly important consumer goods for the past 10 years, but that did not interest us. We get into a situation right now where inflation, CPI, is shown as being very high. It is not transitory. It's obviously very sticky. And the Bank of Canada, as well as other central banks, have stepped in to deal with something that they have identified themselves, though, as being a mixture of supply chain disruptions, energy costs, as well as a rebound in consumer desire for things like travel, like consumer goods. So this is a unique situation that we find ourselves in. And I am unsure how high you can make an interest rate that will make the Chinese give up a zero COVID policy and have them open up Shanghai ports for supply chain issues. I am unsure how high you can make interest rates to make oil prices come down when you've got physical restrictions on just how much refined product is on hand. But I think we're very clearly seeing what happens when interest rates go up on the housing market. So I got to put it to you. You're someone who deals in the lending side of all of this, and you're looking over both the market and what you can bring to the market to help investors or buyers of home, or homeowners, I should say. Do you feel that the Bank of Canada is on the right path here? And are they tackling the correct problem with the way that they're doing it right now through interest rate hikes?
Well, in terms of dealing with inflation, inflation is very real, obviously. We've seen it, as you pointed out, and not just recently, but in the past, in food price increases. We obviously see it in energy, gasoline, day in, day out, we pay more money for things. The thing is about the Bank of Canada is they don't have any choice because they only have one tool. There's only one known tool to fight inflation, and that is what they're doing right now. They're raising interest rates. This is a concept of demand destruction. If we force other things in your life that are not purely consumer, if we force your mortgage payment up, your car lease payment up, if we force all types of borrowing you may have done, if we increase all that, that you just won't have any money left to go buy other stuff. Now, hopefully you won't starve. That's probably not on Tiff Macklin's agenda. But other than that, demand destruction means that nobody wants to bring anything out of Shanghai. So it allows lots of time for the supply chains to heal up because there's no demand coming out for those goods coming out of those factories. This is the central economic concept that the bank is using. It's a very crude instrument. It is terrible for the consumer, but it's all they got. So they're going to keep doing it. There will be another increase in prime rate on September 7th.
Well, I'm going to ask, maybe it's the only tool that the central bank has, but the government has other tools at its disposal. And if I'm to draw your attention to one of your own tweets, I think very recently, today or yesterday, and making mention of Sam Cooper, who we had on this podcast some time ago. We have a lot of foreign money as well that is laundered through Canadian real estate. Sam Cooper documented it very well in his book, Willful Blindness. But it's an interesting, it's difficult to address, but it's quite clear that the Canadian government has not been interested in people who claim $9,000 of income and then spend $14 million on a house. And it doesn't seem to raise a lot of questions, or the red flags that it raised get ignored or simply pushed aside. So maybe the problem isn't to look at the central bank. They've only got the one tool at their disposal, and that's either there's more money or less money and the cost of getting it. Maybe the problem is or maybe the question is, should the government have been more engaged with what was happening in the housing market before we got to this point?
That's just ridiculously obvious if you're in my business. That if you spend all your time financing houses like we do and examining price movement like we do, I've been talking about foreign money and Canadian real estate for going on a decade. It is an obvious contributor to high prices because it's the same effect in the other countries. Australia has ridiculously high house prices. New Zealand has ridiculously high house prices. Great Britain has ridiculously high house prices. And when you go to the key U.S. cities where the prices are off the scale, which is New York, Miami, San Francisco, L.A., those prices are nuts. And then suddenly you compare those prices to Akron, Ohio, or Cincinnati, or any of the Midwestern cities and most of the southern cities. When you take away those key cities in the United States where foreign money comes, those prices in the States fall off a cliff. I mean, you could buy a beautiful 4,000 square foot 2-story home in one of the best neighborhoods in Houston, Texas. You could have a tennis court, a swimming pool, cabanas. It would be the most lovely house you could ever imagine. It's $419,000 US. Okay, it's $3 million here in a good neighborhood.
I suspect that people are going to think that you're exaggerating, but I know for the fact that it's true. It's absolutely true.
Absolutely true. So the reality is that that foreign money has been a very detrimental factor for the average Canadian in their real estate purchases for a full decade. There are many thoughts about why our government has ignored this subject, because they've obviously ignored it. You can't say that the chartered banks in this country are allowed to bring in money from China into accounts held here by dual citizens or people with PR cards, bring in money from China in complete violation of China's own capital transfer rules. Like, you can't bring more than $50,000 out of China, more than $100,000 out of China. Our banks are accepting $20 million transfers out of China. So how does that even make sense if it's against the law in China that we're allowing it here? Look, it's very clear that our government, and not just I'm not just talking about individual parties. I mean, this was the same situation under Harper. We've completely ignored the growth in to the point where in some cases it was denied. When myself and Sam Cooper and a few other people were talking about ridiculous amounts of money coming into Canada to buy real estate, CMHC told us we were wrong and that it's a tiny percentage and we shouldn't be talking about it, or maybe even we're racists. Now, of course, everybody has come to it after the vast amount of documentation that's come to the fore, and thanks to Sam for a great book and never giving up on this topic. It's obvious to each and everyone in the key cities in Canada that foreign money is something that influences prices. Now, will it be dealt with someday? Maybe. Frankly, no initiatives to date. Like literally nothing. There's some empty homes taxes that are going on in Vancouver and poorly enforced. There's a little bit of empty home interest in Toronto. Because let's face it, that's how crazy this is. These people are so rich, they just buy the properties and leave them empty.
Mm-hmm.
I live on a relatively short street. There's only 23 houses. There's two of them one of them hasn't been lived in for 2 years, and one of them hasn't been lived in for 10 years. So if that doesn't tell you that there's empty homes, we've done studies of we've taken photographs of whole sides of condo buildings in downtown Toronto where the lights never went on for a full year. Not ever. No lights at all. The whole side of the building. That means all of those suites were never occupied during the entire year. These are all simple facts and simple truths that not really anyone in our government's interested in. So I don't know whether that'll ever be a point that will change, but it's real. And it's one of the contributors to the super high price of housing, not just here, but again, in Australia and in New Zealand and in Great Britain.
Yeah. I think particularly recently with the Russian invasion of Ukraine, the UK faced a real reckoning on how they turned London into effectively a depositing stop for Russian mafia. I mean,
you mean Londongrad?
Yes, Londongrad, exactly.
Yeah.
I'm going to pivot to one more, I think, equally important issue. There is a lot of debate about NIMBYism and YIMBYism. Is it that we do not have enough housing, or is it that we have enough housing, but a cohort, a group of evil landlords is simply preventing us from buying it? The answer is, I'm going to assume, somewhere in the middle. But as you just alluded to, one of the reasons that I remember the guy took the project and he put a camera up and photographed a condo every night and just showed that there was like 50% of those rooms were never occupied. If there is a sector of the Canadian real estate market that is different than me as an individual homeowner, but is going to be more vulnerable in the future, it must be people who have gotten into being real estate investors, that they have borrowed, so they put down and bought a place, and then they did another one and another one and another one, and potentially dipped into the equity multiple times to get the down payment on the next property. And so they've got a domino-like chain of condos, 500 square foot to 600 square foot things in downtown Toronto, and they are being used as Airbnbs, or they're going to be rentals or what have you. But the point is that they are not, under the usual expectation would have been that they should have just gone to market and bought up competitively by individuals that wanted to live there, and instead have ended up as part of a burgeoning amateur group of people who are landlords now.
Amateur landlords,
yeah. And some of them I think are going to be really I have to assume some of them are going to be very much overextended. The pandemic, I thought, would have done more damage to them with all the Airbnbs. I think particularly the ice buildings down south of Lakeshore.
Well, the government, you recall, the government brought in mortgage deferral.
Yes. So people have stepped in to help out before the stuff could really hit the fan. I'm not sure how long that can be avoided. Am I way off base here? Do we have something that there is a problem here in the market that, that this higher rate should address?
Well, the answer is yes, but real estate, unlike more liquid investments, equities, bonds, mutual funds, unlike those very liquid investments where people can make quick decisions to buy and sell, and they're very active, Real estate is glacial. You may, if you're got condos filled up with students, they're all back now, and at higher rental rates than they were before the pandemic. So depending on when you bought that condo, if it was 5 years ago, you're actually more profitable with these high rents for students and the return of Airbnb, which, by the way, is an illegal hotel room if it's just a small condo. That's really what it is.
Mm-hmm.
Completely illegal hotel room. So it's individual. If your timing was bad and you bought new construction stuff that's coming on stream now when values are falling, when rates are much higher, you may be looking at a problem. Because you might not even, in the case of condos, you might not even have expected to move in. You may have been planning on selling it by assignment for new construction. So there are definitely areas of vulnerability, but it may not be as overwhelming as it appears, because depending on when you bought, the great acceleration of rental rates in most of the big cities in Canada right now, certainly Toronto, Vancouver, the worst, may offset the problem. These are unknowns. Again, it's a glacial marketplace. The only reason that sales have fallen off so far, so fast, this is the lowest sales in July in 26 years, the lowest sales in the TREB system, in the Toronto Real Estate Board. Same in Vancouver. Vancouver Real Estate Board, lowest sales in 22 years. So that's because of rates. Real estate is math. It's mortgage math. It's affordability. Everything slows right down if people look at the payments for the price of the house, put 20% down and look at the payments for the remaining 80% mortgage. Well, I can't pay that. So at that point, you're not buying the house. That's why it happens so fast, so precipitously, and some prices, not all prices, but some prices have fallen so greatly, is that if you double rates in the course of 7 or 8 months, you're going to see a big change in real estate activity. But in terms of people being forced to sell, in terms of people getting in trouble on renewals, in terms of people faced with economic pressure, I look back on the best example is actually 1990 through 1996. You need a long duration. You need a long duration of a poor real estate market to actually bring on forced sales. The price of houses fell dramatically from 1989 to through 1990, stayed flat right through till 1996, like literally flat as a pancake, and then finally started picking itself up in 1996 and gradually starting to move up. But those were cases where during that course of time, during those 6 years, there were many effectively forced sales because slightly higher interest rates, not even as big an increase as we've experienced now, did eventually force people to have to capitulate to the market and to sell houses. And again, that kept the price down. So it's duration. It's going to be the duration of these high interest rates that is going to have the most compelling effect.
So we're getting close to the end of our time here, Ron. And again, I want to be mindful of that. Very quickly then, if it's duration is what we really need to see, we need time to get things rolled over. We need prices to be depressed for a long time. Your advice to someone who wants to get into the market now is to say, look, you got to wait. You're recommending that they could be waiting for a couple of years.
Let me correct that.
Okay.
If we use 1989, 1990 and the aftermath as the best example, because it probably is. If we think about 2008, it was brief. It was a hellacious recession in response to the world financial crisis, but it was over in 10 months.
Yeah.
And it was over in Canada in 10 months. And real estate activity returned. Interest rates were not particularly high. In fact, that was another time, 2009 was another time when variable rates were very low, as the Bank of Canada provided stimulus then. So the recovery was very fast. And here's the thing. If there was probably a 15% drop in prices from the beginning of 2008 till the summer, but by the first quarter of 2009, that was fully recovered. So most people would never notice that anything happened.
Yeah.
Right? Something similar in 2017 when the new rules about foreign buyers came in. That wasn't even a case of a rate problem. And again, some values recovered very quickly, and the prices that fell were almost exclusively in 2017 areas that were just being purchased as investments.
Mm-hmm.
So The better comparison might be 1989-90, and what happened in that time period was a distinct fall in prices going into the middle of from 89 through till the fall of 1990, and then flat. So you could make a case that if we're just for people who want to buy a house, just to be a little more patient, take a look in the new year, in the first 2 quarters of 2023, and that may be a perfectly good time to buy because you don't care if prices remain flat.
Mm-hmm.
You're in the house to live. You're sending your kids to school. It's a place where you live. Okay, so you just don't want to buy a house that's going to be worth $100,000 less in the spring. That's the only real concern. But once it gives the appearance of having leveled off, great time to buy. You don't have to wait any longer.
I'm going to ask a question. I suspect you'll probably feel you've already answered it, given your comments about national housing data. But if you were going to posit how low can prices go? I mean, what is a realistic drop off? I've seen numbers saying that we're, depending on where you are in the GTA now, we're somewhere just north of 20% from the peaks, which is not to say that's when most people bought, but off of our that February number. Mm-hmm. In your experience, do you think there's a number that you want to throw out just for betting purposes, or do you think it's not worth the trouble?
It's probably not worth the trouble because real estate's so regional. You could make a case that there are the price of houses in Rosedale hasn't changed at all. Mm-hmm. By the way, the price of houses in Rosedale didn't take a huge upswing like the price of houses in Guelph and Uxbridge did in 2021. They didn't go up anywhere near those kind of percentages. They were $5 million already. So maybe they went to 5.6, 5.8. It just, whereas in Guelph, something that was previously sold for 580 sold for $1,040,000. Okay, that's over the course of 2 years. That doesn't even make sense if you think about it. So those areas that had the biggest run up are having the biggest fall, and that's all local. That's regional. That's neighborhood by neighborhood. I can say this: as long as these interest rates stay high, as long as a lot of the 5-year fixed rates are 4.99 and over, when variable rate goes to only a rate that's in the 4s after September 7th, prices are going to grind down. They may not grind down fast. They may just grind down slowly, but they will still grind down. Okay. So you will learn, the public can learn about house prices from interest rate stability. If interest rates stop going up, and it's clear and it's obvious, it's not just a theory. We've got some theories floated in the last little while that interest rates are going to stop going up, but it's really just a theory. Once you can say for certain, and consensus is that interest rates have stopped going up, it may be time to think about the prices will eventually stabilize.
I would like to ask you 2 more questions, and then I think we best wrap it up because, as I say, we're trying to stay here within an hour. We had a question here. It's about car leases, and car leases seem to be affected by interest rates significantly.
Yes.
My current car rate is around 2.99. I got a quote on a new lease for 7.99. Can lease rates be negotiated? That's up to the car company and who's doing the leasing. And by a mortgage broker. Would it be wise to add your car to the mortgage so you can finance it at a significantly lower rate? I think the real question there is, am I going to borrow against my house, or is my house going to underpin wider consumption? Or is it better to have my car tied to the financier at the dealership?
The right answer is your car should be tied to the life of the vehicle.
Okay.
I mean, if you actually borrow money through a HELOC or refinance your house through a mortgage to buy a car, it's going to take you in some cases 30 years to pay off the car. That is crazy. It doesn't even make a lick of sense. So it's really important to look at leasing or getting a loan on a car. It's really important to match it up to the life of a car. I've always believed that these 84-month, 96-month leases were crazy. The chances of the car lasting that long are slim and none for a lot of vehicles. So think about the life of the car. Think about how long it's going to be around. And it doesn't make any sense to be saddled with the payment on a car, because that's what you're doing if you take out a new mortgage to buy a car. Saddled with the payment on a car, even at a lesser interest rate, for 25 years. Doesn't make sense.
If someone can pay off the car faster though, because they've used a HELOC and they're saving a couple of points on the rate, you don't see any value in that, or
Only if you have an absolute certainty you can pay the HELOC off, the
okay,
HELOC amount you've borrowed in 4 years, because the car will be gone in 4 years.
right?
Car will be gone in 5 years. So the longer, that's a common error that consumers make. They look at the fact that the rate is lower and the payment is much smaller and say this is a better deal. But in reality, if you have to pay off, you're making payments on that HELOC for the next 10 years, well, you paid 10 years worth of interest. The interest went on every single year. It's not necessarily in your favor at all.
I think again, your point here is this is about math. So
yeah, it's all about math.
Here's my final question. I was again reading through some of the things that you were saying. And you were talking about the Bank of Canada thinks it's got a neutral rate at 3.75%.
Let's call it 3.75 for the sake of calculation. Yes.
So explain what the neutral rate is here, because you went on to say that's going to give us a target around mortgages, and that gives us a bit of a target around house prices.
Mm-hmm.
So what is the neutral rate, and how should we understand that impacts mortgages when we're looking at housing?
Well, typically, the Bank of Canada uses a neutral rate between 2% and 2.5%, which historically is the rate of inflation. That historically is CPI, 2%, somewhere between 2%, 2.5%. So a neutral rate means that the rate is simply reflective of the CPI of the time. Now, CPI was 7.4, last month. So, but a neutral rate of 7.4 would blow the economy to bits. In other words, the Bank of Canada rate raising to 7.4 would blow the economy to bits. So the Bank of Canada looks at a rate that they believe, a neutral rate today, that will achieve eventual, relatively short to midterm, eventual restoration of a more normal inflation cycle. And the hope of the Bank of Canada is to get their neutral rate back down to 2 or 2.5. That's eventually where they'd like to be. So if they have a higher one now, do the demand destruction that I just talked about, and they end up with much less inflation by the second quarter of next year, then there's actually a chance the prime rate can go down.
Okay. Final question, and then we'll say goodbye. Variable rates. If you're thinking about things from the perspective of an investor, you go by the Warren Buffett rule, right? You want to be greedy when others are scared and scared when others are greedy, or some sort of variation of that. Rates are up, and you could be getting a variable rate right now. A lot of people are looking to lock in. And in fact, our first interaction was me calling on behalf of a client whose daughters have a house and, was wondering whether they should be locking in. Your advice was you lock in, you're going to add a couple of 100 basis points, which is at least 3 or 4 interest rate hikes. You're going to pay more and lock in for 5 years, where if you just stay with a variable rate, you felt at the time, I should say at the time, because I think this was some months ago, you're very likely to see a rate decrease within that 5-year period. Why would someone today choose a fixed rate mortgage when rates have already climbed as much as they have? And very likely we're going to start seeing some, potential declines in inflation. Why wouldn't all mortgages be variable rate today?
Well, as you well know as a financial advisor, Adrian, you also have to tailor your advice to human beings' personalities and their thought processes. So there are a certain number of people who are absolutely maddened, stressed, and concerned by the possibility that the neutral rate will go higher than 3.75, that they'll end up with every single day, my staff take calls about people who are absolutely sure prime rate's going to 8. They're positive, they're absolutely certain. So we have to manage people's own level of stress and their own belief structures. I mean, we just can't, my recommendation to manage that is the short-term fixed rates. So if we have a 75 basis point increase on September 7th, we're going to be looking at the best possible variable rate mortgage at around 4.35. And if a 2-year fixed is 4.55, I'm not sure why you wouldn't, just for the sake of certainty, take the 5-year, take the 2-year fixed.
Okay. Well, I think that's a very good answer. Ron, I've really enjoyed having a chat with you today. Thank you for
You too.
making some time out of your day to do this. And I hope we've managed to cover some things that you would consider relevant, and that it wasn't just being asked random questions, but there was some thread here. So thank you very much. We'll put this up on YouTube, and I'll send you the link at the time if you're ever in the urge to watch yourself and me. But thank you very much, and to everyone that watched, and thank you for watching the Walker Report. Cheers.
Thank you very much. Good talking to you, Adrian. All the best. Bye now.